Kevin, it's been a slow year in M&A, but healthcare's bucked that trend. What do you think's driving that?
Well, I think it's a number of things. While the M&A market has been weak, we've seen a lot of activity in the biotech and the pharmaceutical space. There's been some very large transactions. And I think the underlying theme around M&A is similar to what it's been in the past. Large pharma companies are facing patent expirations and a significant loss of revenue of billion-dollar products. They need to fill their pipelines with the next giant blockbuster products for them. And so that's going to drive the M&A activity going forward. The other thing happening here is obviously valuations are down and biotech companies are still having a hard time raising capital. The XBI, the IBB, they're still at levels that we haven't seen since 2019. And that's really creating issues for biotech companies being able to fund their clinical studies, get FDA approval and launch their own products, so they're turning to the pharmaceutical world for acquisitions of those products.
So speaking about valuations, Josh, in your market, because your market drives kind of the leverage that these potential acquirers have with these early stage companies, are you starting to see some good sponsorship coming out of the buy side for these names? Because I know that they got hit pretty hard given the rate moves that we've seen over the last 18 months.
Yeah, look, on the IPO front, we're still a little quiet. We've only seen 3 deals priced year to date. Luckily, all those transactions have traded reasonably well. What we have seen is a significant increase in the follow-on side of the market with 82 deals pricing to raise just under $16 billion. That's up about 180% year over year versus the first half of 22. And the good news is those deals have performed well in the aftermarket. They're up about 8% on average. And the difference, though, in what you've seen this year versus last year is really a couple of different things. One, you've seen that all those deals have come off the back of strong data. In 21, deals were getting raised left and right, early stage transactions. It didn't really matter. And investors really want to see hard, firm clinical data right now before they participate. The other thing that we're seeing is just an overabundance of privately marketed transactions, meaning deals that were wall-crossed first, confidentially marketed, and then announced basically while being oversubscribed, oftentimes being able to upsize. And again, I talked about that aftermarket performance because of the strength from the institutional investor community and participating in these deals under the current structure. We've seen really good aftermarket performance so far year to date.
So are you seeing a bigger valuation discrepancy because of everything you just said between kind of early stage biotech versus later stage biotech?
Yeah, look, I think at the end of the day, the rates have had a huge impact on how the market values things. And that's one of the, a couple of different things that we need to see before we get a very strong second half of the year, or what's preventing us maybe from having a strong second half of the year is the fact that we're at a higher rate environment. And until we get closer to a window where rates are we can see that light at the end of the tunnel in terms of rates coming down, that's going to keep valuations pressured, because the reality is all biotech valuations are done off of future cash flows and revenue. And by definition, in a higher rate environment, those companies are worth less. And then on the M&A side, the other thing that's hurting things right now is the fact that while you have these big acquirers that are willing to put capital to work, at the end of the day, they still have a higher cost of capital than they did a year and a half ago. So until, again, we get to that light at the end of the tunnel, the willingness to go out on the risk spectrum for the larger buyers may not be what we need in order to get the market started on the equity side.
So leverage remains in the hands of the strategics.
Yeah, absolutely. I think so, for sure.
Well, to the extent that the financing, that the acquisition does happen, the financing part is going to be the easiest part of the equation, especially in IG. I mean, if you take a look at the sector and what it provides credit buyers, especially given the current macro, you don't have a cyclicality issue to worry about. You have really strong free cash flows, and you generally have higher credit ratings than most other corporates. And then on top of that, you're able to buy a big liquid deal that's easy to trade out of. So guys are going to line up down the block to buy something like this. And we saw it when we did Amgen. We had a $90 billion book. We saw it with Pfizer, who had almost a similar book, and that was $55 billion of total notional issued on close to $200 billion of demand. So the appetite in our market is clearly there, not only in dollars, but in multiple other currencies. It's just a question if you'll be able to feed the beast.
Yeah, and I find it really interesting that almost half of the pharma M&A this year has been done by non-U.S. buyers.
Yep.
Whether it's Novartis, GSK, Astellas, or Sanofi, just shows you how broad the spectrum is of the buyer universe, how voracious the pharma companies are to fill those pipelines and to achieve revenue growth. I think the other interesting thing here that's going to affect M&A is new therapeutic categories, whether it's Alzheimer's or obesity. these are giant unmet needs that finally have pharma solutions for them. And as development dollars and as R&D dollars are funneled into those spaces, there's going to be a whole new series of targets and companies that are formed around those disease states that are going to be acquired eventually by big pharma.
Big wild card, though, is the regulatory backdrop.
Yeah, absolutely. I mean, next year is an election year, which is bad enough. It usually causes noise around healthcare, whether it's access to care or the cost of care. The FTC has been really difficult, I think, in terms of dealing with every merger, it seems, but even ones that don't seem to have any obvious overlap that limits competition. So it's definitely a wild card. It adds time, it adds expense and risk. And I think that's one of the reasons why there's not as much M&A as you'd think there would actually be, considering the backdrop that we've talked about.
But at the end of the day, the fundamentals of this sector remain quite bullish, just given the demographics, especially in developed economies.
Yep, absolutely.
Josh, your market's fluid because we have to see which direction biotechs go from a valuation and sponsorship perspective. Kevin, your market remains fluid because of all the regulatory issues we talked about. My market remains very stable, but that's inherently the nature of our market. So times will be changing. We all know that. We've been seeing that over the last 2 years or so. But what will not change is Mizuho's commitment to our clients, whatever path they decide to go strategically.